Retirement should be a time to relax and enjoy the fruits of your labor, but many people make financial mistakes that can jeopardize their comfort and security. In this video, we'll explore 20 common financial mistakes to avoid in retirement. By understanding these pitfalls, you can make smarter choices and ensure your golden years are truly golden. Whether you're just starting to plan or already retired, these tips will help you protect your savings, manage your expenses, and maintain your lifestyle. Let's dive in and learn how to avoid these costly errors, starting with investment fees. One of the most overlooked mistakes is paying too many fees on your investments. Not all investments or financial managers are created equal. High fees can quietly erode your savings over time, leaving you with less than you expected. Some advisors even earn commissions from buying or selling stocks with your money, which means more money for them and less for you. Always review the fees associated with your investments and consider low-cost options to keep more of your hard-earned money working for you. Many people underestimate how much they need to save for retirement. In fact, a significant percentage of Canadians have no savings at all. Relying solely on government benefits like the Canada Pension Plan and old age security may not be enough to maintain your desired lifestyle. It's crucial to start saving as early as possible and to review your savings plan regularly. The earlier you begin, the more time your money has to grow, helping you build a comfortable nest egg for the future. People plan to work past retirement age, but this strategy can be risky. Health issues or unexpected life events may force you to retire earlier than planned. Statistics show that a significant portion of early retirees leave the workforce due to health concerns. Even if you love your job, it's wise to prepare for the possibility that you may not be able to work as long as you hope. Build a solid financial plan that doesn't depend on working indefinitely. Many parents continue to financially support their adult children well into their own retirement years. While helping family is natural, it can put a strain on your retirement savings. Studies show that nearly half of parents with adult children still provide some financial assistance. It's important to set boundaries and prioritize your own financial security. Remember, your children have more time to become financially independent, while your retirement funds are limited. Simply saving money in a bank account isn't enough to secure your retirement. While saving is important, investing allows your money to grow and outpace inflation. Relying solely on savings can actually put your future at risk, as inflation erodes the value of your money over time. Consider a balanced investment strategy that matches your risk tolerance and retirement goals. Over the long term, investments tend to provide better returns than savings accounts. It can be tempting to withdraw from your RRSP early to cover big expenses, but this move often comes with significant downsides. Early withdrawals not only trigger tax penalties, but you also lose the benefit of tax shelter compounding. This means your investments won't grow as much over time, potentially leaving you short in retirement. Whenever possible, avoid tapping into your RRSP before retirement age to maximize your long-term financial security. As you turn 71, you must convert your RRSP to an RRIF and start making annual withdrawals. Failing to do so can result in hefty tax penalties. Even if you're still working or have plenty of cash, it's important to follow the rules for tax-deferred accounts. Make sure you understand the withdrawal requirements and plan accordingly to avoid unnecessary taxes and keep your retirement plan on track. You now have the option to delay receiving government benefits like old age security and the Canada Pension Plan until age 70. By waiting, you can receive higher monthly payouts. If you're in good health and expect a long retirement, deferring your benefits can be a smart move. Carefully consider your health, financial needs, and life expectancy before deciding when to start receiving benefits. Carrying a mortgage into retirement can be a heavy financial burden. Your income may decrease after you stop working, making it harder to keep up with mortgage payments. For most retirees, it's best to pay off your mortgage before retiring. This will free up more of your income for living expenses and help you enjoy a more comfortable and stress-free retirement. Even in countries with universal healthcare, retirees often face significant out-of-pocket health expenses. These can include prescription drugs, medical equipment, home modifications, or hearing caretakers. On average, retired Canadians spend thousands each year on health-related costs. It's important to budget for these expenses and consider supplemental insurance to avoid financial surprises in retirement. Many retirees plan to use their home as a nest egg, expecting to downsize or tap into home equity for retirement income. However, there's no guarantee that property values will continue to rise. Relying too heavily on your home can put your retirement at risk if the market changes. It's wise to diversify your retirement plan and not depend solely on your home's value. Reverse mortgage can seem like an easy way to access cash in retirement, but it comes with significant costs. You give up equity in your home and the bank takes a large portion in interest. Reverse mortgages are generally only recommended for those with minimal savings and no other options. Before considering this route, explore all alternatives and understand the long-term impact on your finances. It's natural to want to help your children with their education, but doing so at the expense of your retirement can be risky. Remember, your children have many years to repay student loans, while you have limited time to save for retirement. Prioritize your own financial security and encourage your children to explore scholarships, grants, and loans for their education. Many people dream of a retirement filled with rest and relaxation, but the reality is that more and more retirees are working past retirement age. Some do it for enjoyment, but many need the extra income to support their lifestyle. Make sure you have enough saved before you stop working altogether, so you're not forced back into the workforce unexpectedly. People are living longer than ever before, which means your retirement savings need to last longer too. Life expectancy has increased significantly, and many retirees will live for decades after leaving the workforce. Failing to plan for a long retirement can leave you short on funds in your later years. Make sure your financial plan accounts for the possibility of living well into your 80s or 90s. Timing your retirement during a bear market can have a lasting impact on your finances. Market downturns reduce your portfolio's value and the amount that can compound over time. If possible, consider delaying retirement until the market recovers or adjust your withdrawal strategy to minimize losses. Being flexible with your retirement date can help protect your long-term financial health. As you approach retirement, it's important to reduce your investment risk. Playing aggressively with the stock market can expose your savings to significant losses, especially during economic downturns. Consider shifting to lower-risk investments and diversifying your portfolio. This approach can help you ride out market volatility and protect your retirement nest egg. Maintaining the same spending habits you had while working can quickly drain your retirement savings. Experts recommend planning to spend only 55% to 80% of your pre-retirement income. Look for ways to cut costs, such as cooking at home or reducing transportation expenses. Adjusting your lifestyle can help your savings last longer and reduce financial stress. On the flip side, some retirees are so cautious that they don't spend enough to enjoy their retirement. Studies show that even those with substantial savings often retain most of their nest egg years after retiring. It's important to find a balance, enjoy the rewards of your hard work while still being mindful of your long-term needs. Don't be afraid to treat yourself within reason. As life expectancy increases, so does the risk of cognitive decline in old age. Over half of people who live into their late 80s experience some form of cognitive impairment. It's important to plan ahead by working with trusted family members or professionals to manage your finances. Setting up power of attorney and clear instructions can help protect your interests if you're unable to make decisions in the future. Retirement planning isn't a one-time event. Failing to regularly review and update your financial plan can leave you vulnerable to changes in your needs, the economy, or tax laws. Schedule annual check-ins to reassess your goals, investments, and spending. This proactive approach helps you stay on track and adapt to life's inevitable changes. Inflation can quietly erode your purchasing power over time. If your retirement plan doesn't account for rising costs, you may find your savings don't stretch as far as you hoped. Make sure your investments and income sources are designed to keep up with inflation so you can maintain your standard of living throughout retirement. Taxes don't disappear in retirement. In fact, withdrawals from certain accounts and investment gains can trigger unexpected tax bills. Work with a tax professional to understand how your income sources will be taxed and to develop strategies for minimizing your tax burden. Proper tax planning can help you keep more of your retirement income. Estate planning is about more than just writing a will. It involves making decisions about how your assets will be distributed, who will manage your affairs, and how to minimize taxes for your heirs. Failing to plan your estate can create confusion and conflict for your loved ones. Take time to create a comprehensive estate plan and update it as your circumstances change. Unexpected expenses can arise at any time, even in retirement. Not having an emergency fund can force you to dip into your long-term savings or take on debt. Set aside a cash reserve for emergencies such as home repairs or medical bills to protect your retirement plan from sudden shocks. Holding onto a large home or expensive lifestyle can drain your resources in retirement. Downsizing to a smaller home or simplifying your life can free up cash and reduce ongoing expenses. Consider what you truly need and make adjustments to ensure your retirement savings last. Retirement planning can be complex, and it's easy to overlook important details. Working with a qualified financial advisor can help you navigate investment choices, tax strategies, and estate planning. Don't hesitate to seek professional guidance to make the most of your retirement years. Retirement often brings changes in daily routines, social circles, and personal interests. Not preparing for these lifestyle shifts can lead to boredom or dissatisfaction. Plan for how you'll spend your time, stay active, and maintain social connections. A fulfilling retirement is about more than just money, it's about enjoying life. Avoiding these 20 financial mistakes can make a world of difference in your retirement. By planning ahead, staying informed, and making thoughtful decisions, you can enjoy a secure and fulfilling retirement. Remember, it's never too late to start making positive changes. Take control of your financial future and look forward to the peace of mind that comes with a well-prepared retirement. Retirement should